family mode.
Hello everyone and welcome to our webinar today on journal entries. Today we'll be discussing the topic of journal entries, including what they are, how do they function, what are the appropriate occasions to use them, etc. As the mechanics of creating journal entries are fairly simple, this webinar may be a bit more theoretical than many others. That being said, though I will try to minimize the accounting concepts and terminology, though by their nature, journal entries do demand an amount of accounting comprehension. As usual, I will show examples in both Design Manager and Design Manager Professional, so if you have a question on one platform or the other, feel free to enter into the questions pane on your GoToWebinar panel. If you have any questions that are outside of the scope of today's webinar, feel free to email them to support@designmanager.com. And don't forget, if you miss a portion of today's webinar, you can always review all of our recorded webinars right from our Help Center at knowledge.designmanager.com, and you can go right to the Webinars drop-down, click on Recorded Webinars, and see listings of all of our previous webinars throughout time. Okay, let's get started. To begin, let's first discuss the basic concepts of journal entries. In short, journal entries are used to manually manipulate account balances, and they do so outside of the confines of daily transactions such as entering vendor invoices, recording cash receipts, etc. There are a few important characteristics of journal entries, and they are as follows. First, every journal entry must affect at least two accounts, though it can affect many more if necessary. It is not possible for a journal entry to only affect one account, as this will unbalance our accounting. What do I mean by unbalance? Well, let's take a look at our trial balance, which lists the current balance for each account as of a given month. And those are under Reports, General Ledger, Trial Balance. And we'll go ahead and look at this as of the end of last year. So here we can see all of our accounts listed with their appropriate current balances. And notice if we look towards the end, more accounts, there is a total of our debit balances along with our credit balances. In accounting, the debits and credits of your business in your trial balance must always match. If we allowed a one-sided journal entry, the net debits and credits could not possibly equal. So that's what I refer to as unbalanced transactions. And this leads us to the next characteristic of journal entries, which is that they must have the same total credit amounts as debit amounts. In other words, if we are trying to credit the balance of one account, we must debit the balance of another account or accounts by the same amount. Let's focus for a moment on the concept of credit and debiting accounts, and we'll use our trial balance here for some help. If we look at the beginning of the trial balance, we see all of our asset accounts listed first. Those generally begin with the 10,000 range, and there they are. And those are physical or conceptual assets to the company that increase the company's overall worth. And they generally maintain a debit balance. So if we wanted to increase an asset, we would debit that account. If we wanted to decrease it, we would credit it. Next on our trial balance are liabilities, which are in the 20,000 range, such as accounts payable. And these are instances where the company owes amounts or reduces the value of the company. Next are our equities, such as retained earnings, owner's draw, etc., and they're in the 30,000 range, followed by all of our revenue accounts or sales accounts in the 40,000 range. All three of these, liabilities, equities, and revenue, maintain credit balances, as we can see. So if we wanted to increase one of those accounts, we would credit the balance. If we wanted to decrease a revenue, equity, or liability, we would debit the account. Lastly, we have our cost of goods sold accounts in the 50,000 range, followed by our expenses or operating expense accounts. Like assets, these types of accounts also maintain debit balances. So again, if we wanted to increase a cost of goods sold or an operating expense account, we would debit the account. If we wanted to reduce it, we would credit the account. Now, this gets particularly confusing when you're dealing with banking institutions or you're reviewing your monthly checking statement, etc., as the bank will often reverse these terms, such as the concept of the bank has credited your account for interest. Well, this means that your balance has actually increased. And here's why. From the bank's perspective, they have actually credited or reduced their funding or operating account to increase yours. When you write a check or withdraw cash, etc., you're actually moving funds out of your account into their funding account, increasing it, so that they can make the payment. So it's almost the reverse, as the bank are using those terms in reference to their funding account. Very confusing, I know, but always remember, if you're going to debit an asset, you're going to increase it in common accounting terms. A third attribute of journal entries, and this is extremely important, particularly in accounting software, that journal entries do not have any bearing on a particular project, vendor, client, etc. If you want to remove the balance of a client invoice for non-payment, or the client is disputing the charges or the goods and services provided, you can make a journal entry to reduce the accounts receivable amount and increase a bad debt expense account or bad debt revenue account, for example. But this will not remove the client invoice from your aged accounts receivable report, from the client statement, etc. The journal entry is manually manipulating the balances of the account and has no bearing on projects, vendors, clients, etc. And this leads us to our final point. If you find yourself making excessive amounts of journal entries or are generally not confident in doing so, you may want to contact our technical support for some advice on journal entries, as journal entries should only be used under specific circumstances. And that brings us to the topic of what circumstances are appropriate for journal entries. I've listed a few of the most common and accepted uses for journal entries right here. And here they are. First, making closing entries given to you by your accountant. Now, these are often going to be end of the month or end of the year end entries, and the accountant would simply provide you a journal entry or tell you to reduce or increase various accounts so that they properly match all of your financial statements in Design Manager to the actual income or sales tax filings. Secondly, the accountant may have some reclassification of account balances for tax purposes. For example, you may have closed an open client invoice to revenue, but the accountant would rather have you move that out of the revenue into a bad debt expense account for tax purposes. You could also be recording depreciation or amortization on your accounts. Depreciation, of course, would be the reduction of the value of equipment or other assets. And the accountant will provide you with the journal entries or the account numbers to manually manipulate. Secondly, and maybe even just as or even more commonly used, would be a journal entry to make payroll entries, particularly if you have a payroll service. The payroll service and or your accounting professional, if they supply the payroll service, of course, can provide you with a single journal entry that simultaneously reduces your cash, increases your payroll tax accounts, and even records 401k matching contributions or any advanced payroll practices. This makes recording all of the accounting that occurs during a pay period very simple. Third, accruing costs of goods sold. A slightly complicated concept, but I will describe it in brief. Now, in traditional accounting practices, you generally will have recorded the vendor invoice for a good or service, and upon invoicing your client, the cost of those goods or service will go into cost of goods sold. The difference between the cost from your vendor and the amount you invoiced your client is the income on that good or service. This is a process described in great detail in our work in process webinar. Now, if you invoice your client prior to recording the vendor invoice, your net income will be overstated. You'll have all revenue and no cost of goods sold. And if it's the end of the fiscal year, you're going to be liable for the tax on that income and end up paying the federal government more than you intended. Now in Design Manager, there is a report called the Cost of Goods Sold Accrual Report, which is listed in both Design Manager and Design Manager Professional under your Accounts Payable Reports, Cost of Goods Sold Accrual. And this report lists all of these costs. And at the end of the month or at the end of the fiscal year, you can make a journal entry to increase the appropriate cost of goods sold account or accounts while balancing these costs with an entry to a accrued cost of goods sold liability account. And this gives you a much more accurate picture of your true income while also reflecting the fact that the company does in fact owe these estimated costs in the future. You would then reverse this journal entry at the beginning of the next month to back out that transaction and then do it every month subsequent. It's called accruing your cost of goods sold, and if your business model is to invoice the client prior to recording your vendor invoice, it is a necessary accounting transaction. Fourth, you can very conveniently record service charges such as bank fees, etc. You can also record non-client revenue. Say you get a commission check in from a vendor, or you have an income tax refund, or the bank gives you interest. All of those are not related to your clients and can be recorded very simply with a journal entry. And there are times where you may have sales tax rounding remainders. What do I mean by this? Well, Design Manager calculates sales tax out to 4 decimal places on a per item basis. Now, when you go onto your tax authority's website, you're going to put in the total amount of sales, and they're going to calculate by taking a percentage of that large sales. That could be different by a penny here, a penny there, than the sum of all of the items' sales tax. So at the end, after paying your sales tax authority, you may have a cent or two left over in your sales tax account, which you could easily rectify by making a journal entry to reduce the balance back down to 0 or increase it to 0 quite honestly, and then charging that to a revenue account or a sales tax overage or underage account as well. Lastly, and the one that I always have a little bit of a caveat on, is adjusting items or transactions that were recorded in the wrong month or that are difficult or undesirable to reverse. Now, doing so requires, one, a very solid accounting comprehension of what you're trying to manipulate, and two, having the ability in Design Manager to do so. So say we had a client invoice, for example, that I posted all the way back in February of last year. It's been long paid for. My bank reconciliations have been done, so the payment's already been taken care of. Making or voiding out that entry would be procedurally difficult. But I know that I wanted to move the revenue out of, let's say, a general revenue account into a furniture-specific revenue account. I could do so via a journal entry. Again, higher-level accounting comprehension is needed to do so, and if you find yourself doing those types of things frequently, it would be best to contact Design Manager technical support, and there's probably ways that we could help you manipulate your accounting to do so a lot more conveniently. So those are a bunch of common uses for journal entries. If you find yourself using journal entries for other transactions or other circumstances beyond those, again, feel free to give us a call and contact technical support. Okay, now that we have discussed the theories of journal entries and the uses of the transactions as well, let's walk through some concrete examples. First, I referred to the recording of depreciation of our physical assets. And again, depreciation can be considered the loss of worth of equipment, electronics, etc. over time. Now, normally, your accounting professional would provide you with this information upon completing your yearly taxes. So we'll use depreciation as an example. In Design Manager, we record journal entries under Documents and Accounting, and we go to the Journal Entry and Miscellaneous Cash view. And there it is. And under our Documents and Accounting, Other Entries view, we can see our Journal Entry folder, and we're going to have a folder for each year that I've been using the software and each year that I've been recording journal entries. To create a new one, you can simply click the Journal Entry button along the top toolbar of that window, or I could right-click and do New Journal Entry. Either way, we're going to get to the Journal Entry window. In the Professional platform, we would go to our Accounting ribbon and go all the way down to Journal Entries under the General Ledger frame. That brings us to the Journal Entries window, and under the New tab, we'd click the Add button. And at this point, you can see that the Journal Entry window itself is extremely similar. So we'll do our first example in Design Manager. Now, let's quickly look at our trial balance again. Under General Ledger, Trial Balance, go back to last year. And we can see under our asset accounts, I've got an equipment asset. I purchased some new computers or new hard drives or something along those lines this year, and my accountant indicated that I should put that into my equipment asset account. Now, over time, naturally, these physical pieces of equipment depreciate in value, and I will record that via a journal entry. And I want to do two things. I want to record the accumulated depreciation as sort of a reduction of my asset, and I'm going to balance that guy out with a depreciation expense account. So let's go ahead and do so. Again, the exact numbers of the depreciation will be handed us to our accountant. We'll use some simple numbers. Now, on our journal entry window, we first have an entry number. The Design Manager automatically fills that in for us, and we can certainly leave the auto-generated number. Or if your company or your accounting professional has a very standardized numbering system, you can certainly implement that. Or you could just put something in a little bit more indicative of the journal entry itself. Like I could use something like DEP 14 for depreciation of 2014. The entry date is extremely important in Design Manager, as it's going to determine the month of the transaction, and it's also very important in the professional, even though the fiscal month determines where it would appear on the trial balance and income and statement and balance sheet, but the entry date itself is still very important, particularly with accounts that are calendar date sensitive, such as your checking and bank institution accounts, credit card accounts, or even your sales tax account. So always be cognizant of the entry date that you select as well. Now we'll go ahead and put this in the last day of last year. The transaction description, entirely optional as you know in Design Manager, but I find that to be an invaluable tool when I'm going to review information that I may have entered in weeks, months, or even years prior. And it could be as simple as 2014 depreciation. And there we go. And let's say that our accountant gave us a value that we have depreciated our equipment by $100 to make our example easy. So now that I've filled in my heading information, I want to go ahead and actually fill in the accounts I'm going to affect along with the amount. I do so by clicking the Add button as indicated by the green plus sign. And the first account that I'm going to affect would be our accumulated depreciation asset account. And in this case, since it is an asset and I want to reflect the reduction of my asset, I'm going to credit this. Note, when entering in the amounts for our journal entry, always use positive values. Never input a negative value. The journal entry will automatically either increase or decrease the account balance depending on the account type and whether or not we are crediting or debiting. Since this is an asset that usually has a debit balance, by crediting it, I'm going to reduce it. And the net debits and credits for the journal entry is conveniently listed for me to the right-hand side. If I click OK, Add, I can put in our other portion of our journal entry, which would be for our depreciation expense account. In this case, I'm going to be debiting it or increasing the depreciation expense account by entering in $100 in the debit amount. Upon doing so, notice that the net debits and credits goes down to 0, indicating that my journal entry is currently, quote-unquote, in balance. Click OK. We can see there is our depreciation being reduced, our accumulated depreciation being reduced, and our expense depreciation being increased. Again, we don't need to fully understand the concepts of account depreciation, as the accountant will provide us with that information. We just need to put the journal entry in ourselves. And if we click OK, there is our journal entry listed in the 2014 folder under the appropriate month of December, with our journal entry number and our transaction description listed. And if we take a look at some of our reports, our trial balance, for example, we can see that our equipment itself remains the exact same. But now we have a $100 depreciation, which is reducing our overall assets. This is balanced by an increase of an expense. So again, we always have that concept of a balanced accounting. And if we look at two of the other financial statements, we can take a look at our balance sheet for last year. We can see also here is our assets being listed, and this displays the same information in a different viewpoint. Here is our equipment, and here is the reduction of its depreciation, which reduces the total asset amount. Likewise, on the income statement for last year, we can see an increase in our expenses, which reduces our overall income because of this depreciation of our equipment. So that balanced transaction concept flows and keeps all of our accounting in perfect order. Lastly, let's take one more look. On our journal entry window, I want to quickly point out there is the feature of auto-reversing. What the auto-reverse option does is when we create the journal entry, if I select auto-reverse, Design Manager will automatically make a reversing entry. In other words, if I'm debiting my expense depreciation and crediting my depreciation asset, Design Manager will, in the next month, in other words, January of 2015, it would reverse the two accounts. When is this applicable? This is a great feature for accruing our cost of goods sold. Remember how I had described I would make a journal entry that would increase the appropriate cost of goods sold accounts while balancing it with a liability account at the end of the month to give me a very accurate statement of my true income while also reflecting my current liability. The auto-reverse backs that out and allows me to continue processing and actually getting some of those bills in from the vendors, and I can do that monthly. So the auto-reverse prevents me from having to actually physically make two journal entries. It'll simply back it out for me automatically in the next month. Okay. Let's use another example. Let's hop over to the professional this time. Let's use our example of payroll, again, which is one of the most common uses of journal entries. As I said before, I feel that using a payroll service is an enormous benefit. For a reasonable monthly fee, they handle all the federal, state, local withholdings. They pay all of those entities for you. They process the checks themselves for all of your employees. They provide you with detailed reports of all of the employees' year-to-date totals, tax totals, etc. And payroll is an extremely complicated process, and there are many different services out there that I feel are worth every penny of the monthly fee themselves. And it becomes extremely easy to record the payroll in Design Manager with a simple journal entry. Paychecks, we've actually, as one of the larger payroll services in the country, we've actually created an import for a Paychecks payroll distribution list. So you could go onto your Paychecks site and actually export all of the information and import it into Design Manager. And what it will do is it'll take this Paychecks GL reporting file and actually craft the journal entry for you. A very handy feature. You don't even need to use that. As long as you have the information for Paychecks, you can very easily make the journal entry yourself. One of the best things about those types of services are they provide you with a very specific report, and it's called the Cash Requirements Report. And this gives us all the information that we need to make our journal entry. So first, let's say this is our cash requirements for the beginning of the month prior pay period for our fictional company. So this amount, the $10,471, is the total amount coming out of my checking account. Now, the great thing, and one of the benefits about doing the payroll reporting by journal entry, is we don't have to record the amount for every check separately. And actually, this is more secure. So you may have people working at your firm that have to process accounts payable and generate checks and reconcile the checkbook. If you recorded every check individually for every employee in Design Manager, all of your accounts payable people will be able to see how much each individual is receiving, including their salary, commissions, etc. By having one journal entry that reflects all of the payroll transactions, all that the individual would see is total amounts coming in and out of the checkbook, and they would have no idea of the distribution, how each of your employees are being paid. So it's very secure and limits the access to sensitive employee salary information. Out of all of that funds coming out, we can see what is being derived out of that $10,471. The net pay allocations of $7,000, that's the total amount of my employees' checks, or our company's employees' checks. We can see here, not only does this company provide a payroll service, it also has a 401k. Again, most of your payroll services can easily do that. So the employees have a total of $200 that they withdrew from their check into their 401k. And this company even has a matching amount up to some percentage, and that's also being displayed easily for us. Beneath that are the employee withholdings. These are the amounts that come out of the employees' checks, all of their Social Security, Medicare, etc. All the amounts that we have to pay to the various government institutions that reduce the check balance itself. Along with that are all the taxes that the employer is liable for simply by having employees and paying them. So the employer, the company design firm itself, is liable for Social Security, Medicare, unemployment, etc. And that's a total liability, or the amount that the design firm itself is going to be paying each of those various government agencies. Now, the employee salary total we can easily calculate. This is their entire check amount. So if we put back in everything that was withheld, $23,570, along with their employee 401ks, we can get to the exact amount of the salary amount. So employee salaries equals the net pay, the 401k of 200, all of the withholdings. So we have our 7,000, our 200 from our 401k, and all of our withholdings equals all of the salary amount for our employees. All of the liabilities are what the company owes, along with the 401k employer match. And if that sounds complicated, it might sound that way, but let's walk through the journal entry and you can see how really easy all of this is. So let's hop back over to our professional. And in this case, we'll leave our fiscal month set to the current month for our pay period, and we'll click Add. Again, let's change our entry number to something a little bit more indicative. How about payroll for January 15th? I'll change the entry date to 15th of the month. Description, payroll 1/5 through 1/15. Perfect. Now we'll go ahead and add our accounts. First, let's go ahead and put in how much did Paychex withdraw from the company's checking account. Well, again, they withdrew a full $10,471. So I'm going to select my checking account. Again, our checking is an asset account. To reduce an asset, we credit it. So we'd input $10,471. Now, we don't have to itemize all of our various deductions that were, or the liabilities that we're paying all of the government institutions. As the owner of the design firm, I don't need to record Medicare, Social Security, FICA, etc., all individually. I can have one account to hold all of those. My paychecks, my reports from the payroll service have all of that amounts for me. I can provide that to my accountant if he or she needs it. So I'm going to make my life easy by having a single payroll tax account. So let's add another account, and we'll go down to our 60,000s, and we can see I have just a single account for payroll taxes. And that's going to be all of my employer liabilities. These are expenses that I'm incurring by owning the business. So this would be a debit to my expense account. In other words, I'm increasing my payroll taxes unemployment expense account. Lastly, I'm also matching at this design firm $150. So as the employees put in funds into their 401k, one of the benefits of the company is that they will match up to a certain percentage. So the company is also liable for this $150. So we'll add another account, and we'll put that under our 401k matching expense account. And again, expense accounts increase by debiting. Notice now, as my net debits and credits continues to update, my total amount coming out of my cash is $10,471, which we can easily see from our cash requirements report. I've put in my taxes that the company owes, the 401k that the company provides, and guess what? The balance is going to be that salary amount. So again, I can easily discern all this information just by following through what the report shows me. So lastly, we'd add one more transaction back to our expenses, and we'll put in our salaries. And this will be exactly 9557. So we can see in cash, I have expended, the company has expended $10,471. We put 9557 into salaries, 764 for the pleasure of paying the government for having a business, and then our 401k matching as well. And if we hit OK, we have our journal entry on our new tab ready for posting. And in the professional, I can print out a journal if so desired, I could enter in any additional journal entries that I may have, and then I would go ahead and post. And that drops it off of our new tab, puts it onto our existing tab, so I can edit, void, or adjust in the future if necessary. One more feature on the professional. There may be certain circumstances. If my payroll is, if all of my employees are salaried, I can pretty much assume that my journal entry, my payroll distribution every month is going to be very, very similar. So I have to put that in at least once, maybe twice a month. I may have a automatic withdrawal, for example, for my Verizon business DSL or something along those lines. So professional allows us to have what we call recurring journal entries. And I put one in for a service fee. Every month my checking account has a $12 fee. So rather than creating the journal entry new every time, I've put it onto my recurring journal entries list. We can see I have the entry number, a nice description, I'm crediting or reducing my checking account, and I'm putting a matching $12 debit into my bank service charges. In other words, I'm increasing my service charges. So every month, I simply need to come into my recurring journal entries, tag or select, and hit the choose button. And that brings it right onto my new tab. And I can make any edits to it, for instance, the date or those sort of things, if necessary. But it's a great way to have a template of all of my frequently reused journal entries that I can just select, bring down, and make any particular changes if necessary, and then post away into my financials. So the professional has one more tier of sophistication under the recurring journal entry feature. And with that, it brings us to the end of our discussion on journal entries. And journal entries are a very, very powerful accounting tool, but with that power comes great responsibility. So we discussed the appropriate uses of journal entries. We also discussed the accounting theories behind them. And then we went into the practical entries of putting in a depreciation journal entry that our accounting professional provided for us at the end of the year, along with a very common payroll journal entry as well. And with that, I'd like to thank everyone for joining us on our webinar on journal entries. And again, if you missed a portion of the webinar today, you can always go to our Help Center at knowledge.designmanager.com and simply click on the webinar menu and select recorded webinars to review any of our previously recorded webinars at your leisure. Again, thank you everyone, and have a great day.